Hello everyone, it is Sterling here from Day Trading Forex Live, and we're back for the November and December of 2016 month-end review. November and December kind of brought something a little bit different than what we've been used to. If you guys have been following these month-end videos up through October, we've had, which is an 18-month period of time. I started these in May of 2015. But during that period of time, those 18 months up to October, we had a running 356% profit. That's a compounded gain. And that is 16 months that were profitable, one break even and one loss during one break even month, one losing month during that 18-month period of time. So really consistent on the profit side. And in November and December, we had our largest drawdown since December of actually 2014. So it's been roughly 2 years since we've had an 8% drawdown, which is the drawdown that we had in the month of, or for the months of November and December. We had a max 8% drawdown. Now January and February get back on track. We had a 6.5% gain in February, which will come out in the next video, and then we had I believe it was a 4.7 or 4.8% gain in February, which will be coming out shortly. But learning to deal with drawdowns is important, and that's definitely something we faced in November and December. Now, before we go any further, it's important to understand that I cover the euro dollar and the pound dollar in these videos. This strategy can be traded on any pair that you like. Most members end up trading 6, 8, 10 pairs because the strategy doesn't really require a lot of time to trade. So trading more pairs is relatively easy with this strategy. The euro dollar and the pound dollar give you a sample size that can be representative of, potential of trading more pairs, 4, 8, 10, however many pairs somebody chooses to trade. But even still, you're going to have periods of time where you go through a drawdown like we did in November and December. The other point that I think that this really illustrates is that every time I do these videos, I show you guys that the level we took the trade from was a pre-selected level, which 90% of the points are. We do have criteria for newly created points throughout the course of the day, but as you'll see in these videos, 90% of our levels, or maybe even higher, is a pre-selected point. So with the pre-selected point, once the market gets there, we then use a mechanical entry for determining whether the trade is valid or not. The reason that's important is when you combine a pre-selected point with a mechanical entry technique, you know for certain whether or not that trade was a valid trade or not. It's just like in these months for November and December, we know what trade was. We know that the trades that we're going to show ended up as a loss because, again, it's a mechanical entry. So if it's a loss, there is no way to make it look like anything other than the loss. That's important because it adds perspective to the whole of all these videos, and that the results are about as accurate as you can possibly get, as, again, being that the entry is mechanical, there's no way to make a winning trade look like anything other than what it was, or a loss, as we're going to see going to see our drawdown through November and December. There's no way to make it look like anything other than it is. So when you look at the month-end results, the total results, it should hopefully give a little bit of perspective on the fact that that is about as accurate of a representation as you can get if somebody was taking all of these setups through the course of the trading sessions that we do trade. So we have 5 trades to cover here, and I'll go through them like normal, show you that they're pre-selected first in the videos that we do in the members area, and then also walk through the setup and go through that. So again, 5 trades to cover. We'll start off with the first trade, the 10th of November, which was on the pound. And the level that we had was 24.82. So we'll drag over the daily market preview here from the 10th of December first. And you can see here, daily market preview, 10th of December, the level that we had was 24.82. That was one of our upper points on the pound, 24.82. So if I drag the line down here to 24.82, we come into that level, and just as a recap for those of you that are new to the strategy, there are videos on YouTube that are free that walk through the confirmation entry and explain the entry a bit more detail, so that way I don't have to do it on each of these. You can go back and refer to that video. The bottom line here, during our New York trading session, which as again is a recap, the slender, taller box is the New York session. The longer or wider, skinnier box is the Asian session. So the end of this Asian session is 2 a.m. Eastern, which is the start of the Frankfurt market open, which is when we begin trading. We then trade the next 4.5 hours. And then the New York session, 8 to 12:30, and that's our secondary trading session. So the bottom line here is during the New York session, this is the tall cylinder box, which generally as it's less time. That's why it's usually taller and more slender, as it's an active session during the New York session. We get the break. We need at least a 3-pip break before initiating the confirmation entry. Next candle confirms down, provides the 2 criteria of a confirming candle, and we take the entry on the pullback when it gets to within 20 pips to the high. In this case, that was right here, and as you can see, the trade comes back, stops us out. So that's a 2% loss on that trade. All trades are 2% loss, 4% take profit, 2-to-1 reward to risk ratio. And that is the first trade in the start of this drawdown, which is a 2% drawdown, or excuse me, 2% on this trade. And we have our next trade, which was on the 16th. It was a euro-dollar trade. So on the 16th, the level that we had for the 16th was the 0713 level. And to drag this back over, on the 16th here on the euro, again, 0713, that was our one and only lower listed point for the day. So 0713 is right here, and we come into that level. This is a long candle count. If you're familiar with the confirmation entry, you'll understand that. If not, refer to the video, which talks about that a bit more. You start the stop run over here, and then 4 candles later, or 5th candle, I should say, you get the confirmation back up, and then it shows maybe 15, 17 pips of profit before coming back and stopping that trade out. That was not enough to move to break even, as, again, the trade management rules are also mechanical for that aspect, and that rule says we move to break even at 60% of the take profit, which that did not hit, and therefore was a 2% trade. So there's half of our max drawdown, which again, the max drawdown is 8% that we've had, and that is another 2% loss, which takes us to 4%. Next trade was on the euro again. It was on the 21st. And on the 21st, this was our one break-even trade of the 5, and it was from 0635 on the 21st. And you can see that 0635 was an upper point that we had listed here on, again, November 21st. So 0635, if we take a look at that point, that level was right here. We come into that level. This was during the European session. We get the break. We confirm down. The next candle offers the pullback that we need for the entry. And then at the start of the session, we were roughly about break even. Entry would have been 15 pips from the high, which is right here at 0633. And then the open of the session was about 0633 as well. And at this point from our entry, we were roughly at that break even point. So that keeps us at 4%. We go into the next trade. One thing I do want to cover here real quick, because I'm sure some members will ask, is on the 23rd, a couple days later on the pound, we had a setup that will not be officially listed, and I'm going to walk through some basic principles here why. Let's first go out to the hourly here for the 23rd. So on this day, we had a first push up. We were looking for the second. So this was our first push up. We were looking for the second push up. So when we select levels, we want them to be in the 25 to 65% retracement. 70% is about the end of that, where I will typically draw levels. In this case, the level was about 3 or 4 pips past the 70%. So the bottom of this box is the 70% retracement of the first push. This is about 3 or 4 pips past that. And then what happened, if we look at this trade on the 23rd, is we created this level to the newly created point during the day, came back in, got the stop run confirmed up later. I tend to skew results to the downside for the most part. Like for example, if a trade's 17 pips, a lot of times it's counted as a 15 pip trade. It tends to even out as it goes the other way too. But on trades that are close or maybe just outside the rule set, I tend to skew to the downside, especially if they're a profitable trade. In this case, I know a lot of you guys took the trade, which is why I'm talking about it. But officially won't be counted because, again, it was 3 or 4 pips past that 70% retrace. And so you did get the stop run here, confirmation up, the pullback that you needed, ran off, hit a full take profit, but that's why it's not counted as an official trade. All right, the next trade, we have 2 trades left to cover. Last one's in November's on the 29th. It was on the euro. And the level that we had on the 19th was 0619. So there's the level. We're looking for a second push to the downside from 0619. And when we came into that level, 0619, that was right here. We came into it during the New York session. We had the break. 2 candles later, we get the confirmation down. Obviously, pulls back, stops that trade out. 2% loss. That takes us to 6% down. One more trade to get us to our max drawdown of 8% that we had. So that next and final trade is on the 13th of December. And it was on the pound. It was from 26.63 again on the 13th of December. And what you'll see about this one here on the 13th of December is that we did not have a listed point for the day. So this is an example of a newly created level. Now this newly created level ended up as a loss to take us to our max drawdown during that period of time, November and December, up to 26.63. And so 26.63 was right here. And what we had is a newly created point. We come back into it later over here. We get the stop run. We get the confirmation up. Next candle provides the pullback for the entry, and we have what ends up being a full loss, which takes us to 8% down during those 2 months period of time. Now, through November, so through October, we were up 356%. If you add in the 6% or subtract the 6% drawdown in November, it takes us down to 329% compounded gain. And then if you take away another 2% from that going into December, again, this is compounded, it takes us to down from 329% down to 320%. Now, as I mentioned earlier, January and February were pretty decent months. We're back up to about a 370% compounded gain through those 2 months. But it doesn't change the fact that if you're trading during November and December, you also had to deal with a drawdown. So what I would encourage people to do is look, if you're trading a strategy where you've gone through similar periods of time, you're not trading the DTFL strategy. One of the strongest aspects of this strategy, in my opinion, is the fact that we look for higher reward to risk situations. That by default is what these entries are, because they are looking for a stopping point for a move up, stopping point for a move down. So you are stopping momentum, which tends to put you in near the turn, but it also will tend to reduce a win-loss ratio as you are trying to pick a stopping point in the market. But the point behind that is that with a proper reward to risk ratio, as we'll see through the month of January and February, the next two videos, you can come back, you can pull out of a drawdown much easier than if you had a strategy that had a 1-to-1 reward to risk ratio. Just to get back to break even, you'd now, if you had 4 losing trades, which is what we had here, you now have to have 4 winning trades just to get your profit back if you're not over a 1-to-1 reward to risk ratio. That is psychologically much more difficult to deal with versus knowing that 2 winning trades takes away the 4 losses, and your ability to come back from that mentally is much easier, in my opinion, with a high reward to risk strategy. So I would encourage people to look at your closed trades and analyze what your profit was on your closed trades versus your profit on your losing trades. See what your actual reward to risk is. I'm not talking about what you start out with at the beginning of the trade, because you can technically start out with a 100 pip take profit and a 10 pip stop loss and have a 10-to-1 reward to risk ratio. But at the end of the day, you might close that trade for 5 pips. And if you close that trade for 5 pips, well, now you have a 0.5-to-1 reward to risk ratio. So you're actually worse than 1-to-1. That's why actual reward to risk is so important when you're analyzing your trade. So I'd encourage you to analyze your own trades and give a bit more attention to reward to risk, as with most strategies, and especially this strategy that I teach here, the DTFL bank trading strategy, reward to risk is really critical for long-term success. And it's why we have such a consistent track record over the course of time. It's why and this goes through January and February, which those videos aren't out yet, but that is 22 months worth of trading from the time I started these videos. And during that 22-month period of time, we've had 18 profitable months, 3 losing months, and 1 break-even month. Now, the worst of those 3 losing months was down 6%, which is 3 trades. When you look at that, when you analyze that, in my opinion, what keeps that track record so consistent is the reward to risk behind these strategies. And so again, I'd encourage people to focus on that, as a lot of times if you're losing money, if you analyze your trades, you'll find that you are running a reward to risk which is below 1-to-1 or not much better than 1-to-1 on your actual closed trades. So give that a look, and if that is an issue, start working on that issue, and I think you'll see a significant improvement in your month-end results and your consistency. So that will do it for the November and December video. I'll be back for the next video for January of 2017. Hope you enjoyed the video. Until next time, happy trading.